Hello friends, my name is Sahil and this is my Personal Finance Academy. Welcome to the second part of the video on top monopoly stocks in India. In the previous video, we discussed what is competitive advantage and what is monopoly. Then we discussed the top 5 monopoly stocks including HUL, Asian Paints, Maruti Suzuki, Eicher Motor and Pidilite. If you haven't watched the previous video, I would recommend watching it first. Alright, let's continue and take the next 10 monopoly stocks. Number 10 stock is Nestle. Nestle is the parent company of some of the top brands including the iconic Nescafe coffee, chocolates like Kit Kat, Bar One, Milky Bar and Munch, and the most popular Maggi. Maggi is so popular that people do not say give me a noodle, they say that give me Maggi. Another popular brand is Cerelac. People do not say that give me a baby food, they say that give me Cerelac. Nestle enjoys more than 95% market share in infant nutrition category and more than 40% market share in noodle category. Both these categories would continue to grow on account of increasing awareness towards branded and quality food, especially in the towns and rural part of the country. As the income levels are rising, people would increase the consumption of branded products and Nestle would enjoy a good growth in the future. Over the past 5 years, Nestle profits have grown at a CAGR of 18.6% and its average ROCE is 79.4%, which is again brilliant. Nestle is currently trading at trailing 12-month PE of 77, where its median PE in 5 years is 68. So Nestle is looking fairly valued at current levels and investors can certainly invest in Nestle for a long-term perspective. Number 9 stock is GMM Pfaudler. Established in 1962 as Gujarat Machinery Manufacturing, GMM had a joint venture with American company Pfaudler in 1987 and it was renamed to GMM Pfaudler. It is in the business of glass-lined equipment. GMM Pfaudler had diversified its product portfolio to include mixing system, filtration and drying equipment, engineered system and tailor-made process equipment that finds extensive usage in pharma and chemical industry. GMM Pfaudler has a market share of 50% in Indian glass-lined equipments. Friends, Indian government has a lot of focus on manufacturing with PLI scheme, Make in India and Atmanirbhar Bharat initiative. Sectors like pharma and chemical would continue to grow and GMM Pfaudler has a bright future growth prospect. Over the past 5 years, GMM Pfaudler profits have grown at a CAGR of 30.9% and its average ROCE is 26.7%, which is great. It is currently trading at trailing 12-month PE of 78, whereas its median PE in 5 years is 38. So GMM Pfaudler is looking overvalued at current levels. But I see immense potential in this stock. It is worth investing in this stock periodically for the long term. Number 8 stock is Page Industries. Incorporated in 1995, Page Industries Limited is the exclusive licensee of Jockey International for manufacturing, distribution and marketing of Jockey brand in India, Sri Lanka, Bangladesh, Nepal and the UAE. Page Industry is also the exclusive licensee of Speedo International Limited for the manufacturing, marketing and distribution of Speedo brand in India. Page Industries command a market cap of 50% in Indian men's and women innerwear segment. Friends, as the income levels are rising, there would be more demand for branded innerwear as comfort is the most important aspect in innerwear and that would fuel the growth for Page Industries. Over the past 5 years, Page Industries profits have grown at a CAGR of 11.9% and its average ROCE is 61.6%, which is brilliant. It is currently trading at a trailing 12-month PE of 123, whereas its median PE in 5 years is 66. Clearly, the valuation is very high. One of the reasons is negative earning in June 20 quarter due to COVID. But still, the valuations are expensive. I would suggest keeping an eye on this stock and buy on dips. Number 7 stock is Jubilant Foodworks. Established in 1995, Jubilant Foodworks is the parent company of Domino's Pizza in India. Jubilant Foodworks holds the master franchisee of US-based Domino's and Dunkin' Donut in India, Nepal, Sri Lanka and Bangladesh. It holds 70% market share in organized pizza market in India. If you look at the future growth prospect, Indian society is evolving with a rise in working population, nuclear and individual household, and more outdoor activity such as leisure trip and outing with friends, family and colleague. These factors have increased the frequency of eating out, and this would fuel the growth of Jubilant Foodworks. It has also forayed into ready-to-eat sauces, gravies and pasta segment with brand Chef Boss. Over the past 5 years, Jubilant Foodworks profits have grown at a CAGR of 22% and its average ROCE is 29.7%, which is great. Jubilant Foodworks is currently trading at a PE of 234, which is very expensive. I think this is one stock that is highly overvalued at current levels. Investors can wait for correction to make an entry in this stock, but certainly worth having for a long-term perspective after correction. I have already done an in-depth analysis on Jubilant Foodworks. Number 6 stock is Titan. Founded in 1984, Titan is an Indian luxury good company that mainly manufactures fashion accessories such as watches, jewelry and eyewear. Titan enjoys 60% market share in the organized watch market in India. If we talk about the future, the biggest theme for India in the next 20 years is consumption. There is a rise in salary and people are spending money on luxury items like watches, jewelry and accessories like eyeglasses. Titan is the leader in Indian luxury segment, which has immense growth potential as most of the categories are highly underpenetrated. Over the past 5 years, Titan profits have grown at a CAGR of 12.9% and its average ROCE is 25%, which is good. It is currently trading at trailing 12-month P of 174, whereas its median P in 5 years is 65. Again, the major reason is due to 3 bad quarterly earnings due to COVID. Even if we discount that, the valuation are on the higher side. But I think Titan is one company that every investor should have in the portfolio. I would suggest keeping an eye on this stock and buy on correction. I have already created an in-depth video on Titan. Number 5 stock is CAMS. Incorporated in 1988, Computer Age Management Service Limited is a mutual fund transfer agency to the Indian asset management companies. So basically, CAMS keep a track of investors' transaction in mutual fund, including buying a mutual fund, redeeming a mutual fund, switching in and out, changing bank mandates, updating personal information, etc. CAMS has a market share of 70% of the total asset under management, that is AUM of Indian mutual fund industry. It basically uses technology to provide the services to AMCs. Friends, if you look at the mutual fund industry in India, it is still in the nascent stage. In the future, many investors would invest via mutual fund, and this sector would see a tremendous growth. CAMS being the leader in RTA would continue to grow. Over the past 5 years, CAMS profit have grown at a CAGR of 17.9% and its average ROCE is 49.4%, which is excellent. It is currently trading at trailing 12-month PE of 57. Since it has its IPO in October 20, we don't have historical data to compare the valuation, but generally speaking, CAMS is a growing company with high profitability and it would continue to command premium valuation. I think CAMS is looking fairly valued at current valuation and worth buying for long-term wealth creation. Number 4 stock is IEX. Established in 2008, Indian Energy Exchange is a energy exchange licensed by Central Electricity Regulation Commission for spot trading in power, electricity and trading of renewable energy certificate and energy saving certificate. The main activity of the company is to provide an automated platform and infrastructure for carrying out trading in electricity unit for physical delivery of electricity. If you look at the future growth, the per capita electricity consumption is expected to grow on account of rapid urbanization, growth in manufacturing sector and various government initiatives including 24/7 power to all. In fact, the future is about electric vehicle and that would again require charging infrastructure. Most of these charging stations may end up buying electricity from these power exchanges. Over the past 5 years, IEX profits have grown at a CAGR of 16% and its average ROCE is 63.9%, which is exceptional. IEX had its IPO in October 17 and it is currently trading at a trailing 12-month PE of 50. The median PE is 31. So currently IEX is trading at higher valuation as compared to the median PE. But this is again one stock that can be considered on buying on dips for a long-term perspective. Number 3 stock is APL Apollo. Established in 1986, APL Apollo Tubes Limited is one of the largest producer of structural steel tubes in India. Its product offering include over 1100 plus variety of pre-galvanized tubes, structural steel tubes, galvanized tubes, MS black pipes and hollow sections. Apollo Tube has a market share of more than 50% in structural and galvanized tubes in India. In the future, there would be more and more demand of steel for building the infrastructure of the country. This would continue to drive the growth of APL Apollo Tubes. Over the past 5 years, APL Apollo profits have grown at a CAGR of 30.1% and its average ROCE is 21.4%, which is exceptional. APL Apollo is currently trading at a trailing 12-month PE of 52, whereas its median PE of 5 years is 22. Clearly, it is overvalued. The better strategy would be to buy the stock periodically. Number 2 stock is Indiamart Intermesh. Established in 1999, Indiamart Intermesh is the largest B2B online market space connecting buyers with sellers. It enjoys more than 55% market share in India's online B2B classified space. It provides a platform to small and medium enterprise as well as individuals to showcase their products and services on digital platform. Today, Indiamart has a portfolio of 12 crore plus buyers, 64 lakh plus suppliers and 7.1 crore plus listed products and services. It has a profit growth of 40% in the last 5 years and current ROCE of 84%. Indiamart is currently trading at trailing 12-month PE of 96, which is clearly overvalued. I would suggest waiting for correction to invest in this share. Number 1 stock is IRCTC. Established in 1999, IRCTC is the only company authorized to sell railway tickets for both online and offline channel. It is the only company authorized to sell water bottle in the entire railway network. It is the only company authorized for catering in Indian Railway. Friends, as more and more people are interested in travel, there would be demand in every category including online ticketing, water bottle and catering services, including online catering as well as chain of cafes and restaurants within the railway network. IRCTC enjoys the true monopoly in the business with 100% market share in Indian railway ticketing, railway catering and railway water supply. Over the past 5 years, IRCTC profits have grown at a CAGR of 32.3% and its average ROCE is 52.2%, which is simply brilliant. IRCTC is currently trading at trailing 12-month PE of 154. The reason for such high PE is due to poor earning in last 3 quarters due to COVID. But IRCTC is one stock that has a potential to give 10x return in the next 10 years and a must-have stock in the portfolio. So this is my list of next 10 monopoly stocks. If I summarize, the next 10 monopoly stocks include Nestle, GMM Pfaudler, Page Industries, Jubilant Foodworks, Titan, CAMS, IEX, APL Apollo, Indiamart Intermesh and finally IRCTC. Please note that I have updated the live tracker with these monopoly companies where you can get all the required information like market cap, current market price, PE ratio, sector detail, 52-week high, 52-week low, etc. You can access this live tracker for free on my website.